Hi traders, it's Carlo from Blueberry with a market update. This week markets have been driven by three main forces: the escalating tensions and therefore war between US and Iran, the subsequent sharp spike in oil prices, and a significant market repricing of Fed Reserve rate cut expectations. What should also be top of mind for traders is the continued news coming out of the Middle East, as well as non-farm payrolls later this week. Let's break it down step by step and look at some key charts driving price action. The first key event this week was US and Israel attacks on Iran. Now, whenever there's instability in the Middle East, markets immediately focus on energy supply risk. In particular, the passage of oil and LNG through the Strait of Hormuz, with the Iranians trying to block trade and block supply routes, and the United States trying to reassure markets that they'll keep the Strait of Hormuz open. The first chart I'm looking at is a daily West Texas crude oil chart. Notice a gap up after Monday morning, soon after we saw the US-Israeli strikes on Iran. Quite a strong impulsive move. We really haven't seen any pullback as yet. Any news that comes out of the Middle East will remain sensitive for oil traders. What are the technicals telling us? For traders who are keen to remain long oil, let's zoom out here because oil prices have immediately reached the swing high point back in June last year of around 76.5 US dollars. But it's these levels here to keep in mind, around 79 US dollar barrel on West Texas, and also around 83.60, $84. These may potentially be your next targets for traders looking to hold onto long positions. The stochastics oscillator below is above that 75 level, suggesting support to the current uptrend. We can see here the moving averages, a 20-day EMA moved above the 50-day EMA back in January, and oil hasn't looked back. It actually gathered momentum. Any dips in oil prices will be dependent on news coming out of the Middle East. There is a gap there obviously for Monday, and to fill in that gap, we do really need to see positive news, such as the Strait of Hormuz staying open to oil and LNG traffic. Staying with the West Texas crude oil chart, you can see how momentum followed through after the initial gap on Monday morning. This, of course, wasn't just short covering. It was key news, volatility expanded, ranges widened significantly. And that tells us that the market was building in a risk premium into energy prices. And this matters beyond oil prices because higher oil prices feed directly into inflation expectations. Energy costs affect transportation, manufacturing, consumer prices. When crude rallies aggressively, traders immediately reassess the inflation outlook, and that leads to the next major development, and that is markets have started to reprice Fed rate cuts that were penciled in the Fed's dot plots back in December for 2026. Let's take a look at the currency market. The next chart I have is the US dollar index on the dailies. Now, as oil prices have spiked this week, markets have begun pushing back expectations of Fed rate cuts in 2026. And their thinking is simple. If oil prices do stay elevated, that may lead to high inflation risk. Of course, with high inflation risk, there might be fewer or delayed rate cuts in the United States. And with fewer rate cuts, this can be supportive for US yields as well as US dollar. Now, the US dollar index chart in front of me, you can see that traders have quickly pushed that higher. And this move reflected safe haven flows at the start of the week, as well as repricing of monetary policy. The daily chart shows a strong uptrend since the beginning of 2026, as you can see here, with stochastics above the 75 level, adding to that strong momentum. Now, what I'd like to point out here is that we've had a double top around November last year in the US dollar index around 100.40. So for traders who continue to be bullish US dollars against a range of currencies and you're trading the dollar index, keep in mind potential target for you could be around 100.40. Any dips to this uptrend may be well supported around this uptrend line coming in around 98, and that coincides with the moving averages as well. Next, the dollar yen chart on the dailies. This pair is highly sensitive to yield differentials. As US yields moved higher on reduced rate cut expectations this week, or the repricing of, dollar yen has responded by pushing upward quite strongly. And this currency pair dollar yen is a clean expression of monetary policy divergence and a strong indicator of macro repricing in action. What are the technicals telling us? Well, it mirrors the US dollar index we saw before. Decent uptrend on the dailies. You can even see the moving averages have crossed over. Potential golden cross right here when the 20-day EMA in yellow crossed above the 50-day EMA in blue. You've got stochastic staying above the 75 level, also potentially bullish signal. And in terms of traders who are keen to stay long dollar yen, you've got that 159, 160 region. Now we have been around this area for quite some time. Each time dollar yen pushes towards this level, you might expect rhetoric to increase from the Ministry of Finance and Bank of Japan in terms of intervening and supporting the weaker yen. Will that intervention be effective? We know that through comments from US Treasury Secretary Scott Bessent. He mentioned that the United States, about a month and a half ago, will not be supporting Japan in terms of helping to support their weaker yen. So perhaps intervention may not be as effective. However, it is a level to keep in mind, a bit of a loose or weak line in the sand for traders if you are long dollar yen. Also note that Japan is a net importer of energy. That includes oil and LNG. So as prices spike even further, if they do, in oil and LNG prices, then one may think that the yen could weaken further. Let's now take a look at the gold chart for traders. There are two competing forces at play here. You can see here gold initially spiked after the weekend's events to just above 5,400 US an ounce, but it has pulled back quite sharply to below 5,000 US and currently trading around 5,155. Now the two forces at play are, of course, the events in the Middle East, which have supported safe haven demand for gold. And in contrast to that, markets repricing the Fed rate cuts for 2026 has led to higher bond yields and higher US dollars, which can put downward pressure on gold. And that is what we're seeing right now. Gold prices did fall, but closed above that 20-day EMA in yellow. So it's acting as a bit of support. We did see stochastics fall sharply as well. Where to from here? Well, gold's going to be very sensitive to further news out of the Middle East, as well as US non-farm payrolls data on Friday. Key levels to keep in mind, of course, the spike higher at 5,400 we saw on Monday, and 5,000 seems to be support for now. Now, attention turns to the key catalyst to close the week, and that is US non-farm payrolls. On the calendar, we can see expectations for non-farm payrolls for February, around 59,000 jobs to be added, compared to last month's increase of 130,000. I'd like to take a look at the equity markets charts. I'm looking at the Dow Jones 30, because equity indices are sensitive to interest rate expectations. And because of that, we have seen equities come off in general. The Dow has been trending lower in the last month and a half since breaching 50,000 early February. Equity indices are currently sensitive to interest rate expectations. If we do see a stronger than expected non-farm payrolls data, that may reinforce the higher for longer narrative on US interest rates, support the US dollar, keep bond yields elevated, and put some downward pressure on US equity markets. If the data does come out weaker than expected, weaker than that 60,000 market consensus, it may soften rate cut expectations, thereby confirming 2 rate cuts that the Fed has projected in the dot plots back in December. We may see the US dollar ease back, and that might provide short-term relief and support for US indices. So going into non-farm payrolls data, traders should watch the US dollar reaction first, US bond yields, and then equity index follow through. So volatility has returned to markets, and while that brings risk, it also brings opportunity for prepared traders. As always, manage your risk carefully and stay disciplined. Thank you for watching, and I'll see you in the next video.